Good morning, friends. Hope you've had a wonderful last week and that you're looking forward to a great coming week. What really happened is that I'm recording on the weekend, hence I'm referring to a past week and in an upcoming week. But anyhow, we're here and I'm once again happy to have you at Etienne's Place. And today we continue to explore some of these topics that gives us, the guidance that we need as business persons, business people. Now, over the past couple of weeks, we've been looking at IRS, we've been looking at IRS notices, we've been looking at the different types of notices, the implications, etc., etc., etc. Today, I want us to take some time to look at some of the grace and mercy, so to speak, of the IRS. Because the truth is, it is not the intention, it is not the objective, it is not the primary focus of the IRS to terrorize taxpayers, to make your life be a nightmare, to have you worrying day in, day out about possibility of wage garnishment, bank levy, etc., etc. No, usually it comes to that, when all else has failed. So today we want to look at some of the provisions that the IRS has made for taxpayers who, for one reason or the next, find themselves with some tax debt. Okay? Now it is evident that with a tax bill, the best option, if possible, is to have this paid promptly and paid in full. Paid promptly, paid in full. Reason? Of course, the obvious thing. The two things that we call interest and penalties are to be avoided at all costs, but as much as possible, you want to prevent those. So what it means is that in the absence of prompt and full payment, then there is a possibility that a taxpayer will be impacted by interest and penalty. Interest is the cost of money, the cost of capital. So you owe the IRS some money. You fail to pay them on time. And like any other institution, the IRS will charge you interest on that outstanding debt, tax debt. At the same time, too, there are penalties involved. Penalties, especially quite often, individuals who do not pay, you may find that they also did not even file. Remember I said earlier on that filing and payment, two different things, right? So there's the interest consideration and there's the penalty consideration. So definitely, if you can pay in full and on time, that's the best way to go. Now, in the event that you can't, then we're saying that instead of waiting and ignoring and getting all these letters and threats, etc., and we have gone through all of that nightmare issue, there are certain provisions that the IRS has. And so we're going to look at a couple of them this morning. And I encourage you that if you fall in that category, if you're in need of these provisions, that you listen, consider, consult with your tax person, your business consultant, your accountant, whosoever, and decide which would be the best way for you to proceed. Okay, good. So in the absence of being able to pay in full and on time, one of the things we want to look at is an installment plan. It's a very simple thing, an installment plan. You cannot pay the full $5,000 on time. So we're asking the IRS to give us a payment plan. Now, the good thing about it is that a payment plan is something that you can actually establish in the tax returns at time of filing. So if you come to prepare your 2018, 2019, whatever tax returns, and you want to at the same time apply for what we call an installment agreement. This agreement, the application for this installment agreement can actually be included in the tax returns, so that when you electronically file your taxes, it goes to the IRS with the application for an installment agreement included. So that saves you from having to call the IRS, wait on the phone, get a representative, go through all the details, etc., etc., etc. Okay, so that's a very good thing to go. That's an installment plan. Of course, if you fail to set up an installment agreement in the tax returns, then yes, you just have to call. You can go online, or you can call through to the IRS and have a discussion and decide what, to set up your plan. Very important to note that even with an installment plan, you'd want to pay up this tax debt as quickly as possible. Because although you have an installment plan, a payment agreement, there's always going to be interest, mark you, yes, there's always going to be interest charged on the unpaid balance at the end of each month. So you're paying down your $5,000 bill. Yes, you're keeping up with your payments. You're not missing one installment. But remember, as you pay this bill, as you pay down this balance, like any other loan, there will always be, at end of month, a balance outstanding. And you're going to have interest calculated on that. And therefore, yes, you have a payment plan, an installment agreement, but then try to, clear it as quickly as possible. By law, the IRS, or taxpayers rather, taxpayers are allowed up to 6 years, 72 months to pay, to make, for that installment agreement to run. So usually when you take the amount of taxes you owe and you divide it by 72, that's 612.72, you find that you come up with a very, very manageable monthly installment figure. It is advisable, and this is my advice to you, if you're setting up a payment plan within the tax returns or by calling the IRS, divide your tax owed by 72 months to determine what is the minimum allowable monthly payment. Let us say that it came up to $60. Set the payment plan just for the $60. However, because you know, and I know that you know, that you can afford more than $60 each month, then your actual payments are going to be as much as you can afford. So in 1 month, you can afford $100, pay that. $200, pay that. $150, pay that. But your contracted amount to pay as per the installment agreement is going to remain at the $60. So although you might be able to pay $150, $200, it is ill-advised for you to say, okay, let me set the payment plan for the $200. Because if in a month you're unable to pay the $200, then you would have defaulted. But if you set the payment plan for $60 and you're always paying $150 and $200, then of course you're fast tracking your repayment. And if there comes a month when you cannot afford the $150 or the $200, you revert to your $60 and you're good to go, because that is what the plan was set for. Okay, so set it for the minimum, for manageability, for ensuring that you do not default, but then pay as much as possible each month. So remember now, the maximum time allowed is 72 months, but hey, who wants to spend 6 years trying to pay off a debt to the IRS? You try to fast track it as much as possible, okay? So that is very, very good. Now, quite often, when you, especially, depending on the amount you owe, when you apply for a payment plan or an installment agreement with the IRS, then for individuals, the IRS will have you fill out a particular form that's called a 433-A form. This is really a collection information. It's an information gathering form where it just go into all aspects of your financial life. Okay, basic biodata, yes, but then it goes into your income, your assets, your property, car, retirement account. Everything about you has to be put, your bank accounts, your investment accounts, their balances, etc., etc. And your monthly income, your regular monthly household expenses, all these have to be entered on that 433A form, because that is what the IRS is going to use to determine your, how affordable it is for you to go on this plan and how much they think, you'll be able to pay. Okay, so that's a 433A form, 433-A, that's what it's called. So then, based on the information on that form, it will be determined whether or not, yes, we give you a plan, how much is the plan, etc., etc. Now, there are times when, having completed this form, the numbers indicate that this person is really unable to make any payment on a collection plan. So there's no point continuing to pursue this person at this time. And so this person's account could fall into what we call uncollectible status. Meaning, the IRS is saying, I'm going to put an indefinite hold on your account. I'm not going to cancel it. I'm not going to clear it. I'm not going to zero out the balance. But I've realized, based on information provided, that at this point in time, you're unable to make any payment. And so your account goes into what is referred to as uncollectible status. And so you go year in, year out, still having this tax debt, still having this bill, but not being forced or being pursued by the IRS to make payments. Now, you have to keep the IRS up to date and informed about your financial status, because the day it is ascertained, usually through your tax returns, that your financial conditions have changed for the better, then the IRS will at that time consider removing your account from uncollectible status and start enforcing, insisting that you now start to make repayment of that tax debt. So there's an uncollectible status for those who really cannot afford to make any payment at this time. Cool. Now we come to a third component, which is called, and that's one that a lot of persons would lean to, an offer in compromise. Offer in compromise. Essentially, you're saying to the IRS, I owe these taxes. And either one, I am unable to pay this figure, 10,000, 12,000, 15, 30,000. Or B, if I was to be asked or be forced to pay this figure, it would cause me some significant financial stress. Okay? It would, as it were, threaten my day-to-day livelihood. I wouldn't be able to pay my rent. I wouldn't be able to buy grocery. I can't buy my medication, etc. So yes, I owe it. The money is there that I could do, but if I do that, it would cause me extreme financial hardship. And on the basis of that, or on the basis that I cannot afford it, then you're saying, the taxpayer, you're saying to the IRS, I would like to make an offer. And this offer is basically seeking a compromise between I, the taxpayer, and you, the IRS, where I'm saying, yes, I owe $10,000, but would you consider accepting $3,000, $4,000 as full settlement of this $10,000 tax bill? And that is done all over the place. Banks do it, credit card companies do it. When there's a problem, and it can be ascertained that we may never be able to collect everything, then the best thing to do is to come up with a settlement. For tax purposes, in dealing with the IRS, it is referred to as an offer in compromise. So you're going to make a submission to the IRS. You're going to say, I owe this figure, can't afford to pay it, etc. I'm asking you to consider a compromise. Again, this 433A form, and if you're a business, you might have a 433B, but we're focusing on the A. This 433-A form has to be completed, okay, to support the offer in compromise request. So the 433A is completed with all the financial information, and then the offer in compromise is prepared. And if I remember, it's a form 656, whatever. But your tax person, your accountant, etc., is the one who will work through. Mark, you can do it yourself, but sometimes taxpayers prefer if a professional, undertakes it, because there are some little technicalities about it. Good. Now, the offer in compromise, among other things, takes two key components into consideration in making a determination. One, it looks at what we call your residual income, meaning, remember, one of the information that you have to put on the 433A is your monthly household income and your monthly household expenses. So if your monthly income is 5,000 and your expenses when tallied up is 4,000, then you arrive at what is referred to as a residual income or disposable income or balance of money after expenses of, say, what figure did I use? Can't you remember what I just said? So let me go again. So you had a $5,000 income, $4,000 your expenses, or $4,500, then yes, your residual income, money left after expenses, would be $500. That's 5,000 minus 4,500 give you $500. Okay, that's one. That's your residual income. Also, the IRS will consider what we refer to as your net assets. So the IRS is saying, on this 433 form, show me all your assets, all your liabilities. So your bank account, your car, your house, your investment accounts, your retirement fund, etc., etc. All these things that you own, or these things that are owing to you, these are all your assets. On the other hand, you will have a car loan, you will have car loan, you will have also debt, mortgage on your home. You may have different types of debts. So on the one hand, your assets are tallied. On the other hand, your liabilities are tallied, and the difference is found. If your total asset is greater than the liabilities, then you have a net asset balance. Okay? And of course, that net asset is going to show a positive value that you own. So with the positive asset value that you own, plus the residual income that was calculated earlier on, the IRS would determine that use these numbers to determine your affordability to repay this money. So it means, therefore, some persons would have such an attractive position, big net asset, big residual income, that the IRS is saying, oh no, you don't need an offer in compromise. You have enough assets that you can liquidate, or you have enough residual income that you can apply to this tax debt. So there's no need for you to be getting offer in compromise. We will not agree to accept a lesser figure in full settlement of your tax debt. No, you need to pay your full tax bill. That is your offer in compromise. Okay. Now, offer in compromise, yes, it's an involved process. It's a lengthy process, time consuming. It could take 8-9 months, a year and a half, depending on the complexity, depending on the information provided, how much additional information that the IRS is requesting, or prompt you are in submitting the information, or thorough you are, etc. So all these things come into play. But of course, that is your other option. So if you notice, those are things that are there provided for us as taxpayers to help us with our tax debt. Now, I want to spend a little time looking at what is referred to, and you may have heard it all over the place on the net, on the air, in print media. You may have heard talk about what is referred to as fresh start. Fresh, F-R-E-S-H, fresh start. This is an initiative geared towards making life a little easier for taxpayers, geared towards making it easier for taxpayers to qualify for a lot of these things that I just went through, such as installment plan, penalty abatement, offer in compromise, etc., etc., etc. Okay? So the first thing I want to look at are the penalties. Now, usually once you are late in filing or paying your taxes, apart from interest, there's going to be some penalty involved. Under the Fresh Start Initiative, the IRS is saying, the feds are saying, the IRS is saying, I will allow you up to 6 months of grace period. So I'll waive it for the first 6 months after your failure to pay your taxes. The IRS is allowing you a 6 month waiver of penalties. That's just giving a little more time to get your monies together, to borrow some money, to call your grandfather from overseas and say Western Union some money, whatever you need to do. So under the Fresh Start Initiative, the IRS is saying, I will give you a 6 month waiver. So the first 6 months after your failure to pay your taxes, we will sort of waive the kind of penalties that you would face. The next thing to consider, which another component of the Fresh Start Initiative, is that in the past, for you to qualify for an installment agreement, for you to just qualify almost automatically for an installment agreement, then your tax debt had to be up to, but not more than $25,000. So, you know, for persons who have $26,000, $27,000, not that you will not get an installment agreement, but you have to go through the rigors of the 433A, the interview, etc., etc. But up to $25,000, it was almost like, yes, we'll give you a payment plan, assuming, you know, all things are equal, so to speak. Under the Fresh Start Initiative, that threshold of $25,000 is now moved up to $50,000. So you can owe up to $50,000 and still find it easy to qualify for an installment agreement, for a payment plan. All right. So a lot more taxpayers are now able to access this provision, so to speak, whereas in the past they were outside of that loop, of that net. But now, even if you exceed $25,000 up to $50,000, you're able to get into that net of, or that pool of persons who will be considered for the installment agreement. Next thing, we go to the tax lien. Again, pre the Fresh Start Initiative, once you had a tax bill that amounted to, say, above $5,000, then it is likely, it is possible, and more like it would happen that a tax lien could be issued, you know, from the IRS. Okay, up to, once you have a little more than $5,000, then you are a prime candidate for a tax lien. Under the Fresh Start Initiative, that figure again has moved to $10,000. So it means, therefore, that if you know owe $5,000, $6,000, $7,000, $8,000, whereas in the past you'd be a prime candidate for some, you know, letter from the IRS saying we're putting a lien on your property. Now the IRS saying up to $10,000. So once you exceed $10,000, then you're back in that tax lien realm. but prior to the Fresh Start initiative, you only had to be in excess of 5 and you're there. But now we have an additional 5,000 breathing space, so to speak, before tax lien would be considered. Very important. Now, Mark, although the threshold has been moved from the 5,000 to the 10,000, it is still critical to realize and to know that the IRS, if it considers it necessary, even where you have a tax debt of less than $10,000, if it considers it necessary, may still issue a tax lien for a figure that's even less than 10,000. So if the IRS has good reason, it will still levy a tax lien on you even where your tax debt is less than $10,000. Okay, good. And the last thing we'll mention under the Fresh Start initiative is back to that offer in compromise. Now, I hinted earlier on that the offer in compromise, you see, the offer in compromise. Okay, let me put it this way. I have had clients who come to me owing. I remember a client owed something like $120,000. And at the end of the process of preparing, submitting, defending, etc., the offer in compromise, we were able to settle with the IRS for $25,000. Okay, good. It did not necessarily happen like that at all times, but I'm saying it's possible. But of course, if you owe the IRS $100,000 and you're going to get them to accept $20,000 as full settlement, come on, people. You have to come good. You have to give them all information. They'll have to ask all the questions. You'll have to give answers that are satisfactory, that is evidence-based, etc., etc. And it is time-consuming, can be a little traumatic for the tax payer, etc., etc. But at the end of the day, it is something worthwhile pursuing and something that can give you a very, 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 very attractive result. But of course, as I said before, the rules of the game are very stringent, very onerous. Under the Fresh Start initiative, a lot of these things, a lot of these requirements and these rules and these guidelines have been slackened somewhat. Not removed, but they are less stringent. And as a result of that, it allows more taxpayers to be successful when they make such an application for some compromise. Okay, so the Fresh Start initiative has now made it a little easier for individuals to qualify under the offer in compromise heading, under that heading, so that if your numbers are right and your truths are true, that you should have a very attractive result. Okay. The beauty about offer in compromise also is that, using some numbers now, let us say you owe $100,000 and you're able to get an agreement, a compromise where the IRS is saying, I will accept $20,000 as full payment from you. That is good. That's wonderful. Hippie hooray. But even more than that, the IRS still has now, to by law, allow you 24 months in which to pay this reduced figure. So not only are you getting a significant break from a $100,000 tax bill down to only a $20,000 figure to repay, you go one step further, because the IRS is saying, now that I've agreed to accept 20 for a full payment of 100, I will also give you 2 years, 24 months to pay off this 20,000. So it's all good. Okay, good. So I thought this one I would just indicate that it's not all doom and gloom. There's some element of grace and some element of mercy in our IRS interactions. Okay, So I would encourage my clients, my friends, families, etc. Consider this, because some of us, we have these tax debts that have been lingering for 4, 5, 6, 7 years, and we're just afraid to approach them. But there are provisions out there. There are ways, there are avenues that we can explore. So I encourage you to, if you think you need that, speak to someone, consult, and see which of these, which of these paths works best for you. Okay. So again, thank you for joining me, for spending some time with me at Etienne's Place. And I encourage you guys to continue to subscribe. Yes, I see some more subscribers are jumping on. And I tell you, life is a perpetual learning experience, because just from the feedback that I've received from my viewers, my listeners, whatever, you have evoked some ideas in my head, and I'm looking at them saying, "Ooh," as I said before, I didn't even think about some questions that I ask evoke, in me some a level of curiosity that caused me to explore, and then so basically you're helping me to learn, and I love the partnership. Okay, I love the partnership. So enjoy your week to come. Be safe. Work hard. And this is David Etienne signing out from Etienne's Place. Be good to yourself, work hard, pray hard. Bless.